Welcome to Money Script Monday. My name is Andrew Keehn. Now today I want to talk to you about the truth behind the cost of an IUL. Now there are a lot of ways to structure or design an IUL, but only one way to do it correctly, and that is a maximum funded design where we buy the least amount of life insurance that the IRS will allow, and we fund it right up to the Internal Revenue Code guidelines. Today I want to take a deep dive analysis on the costs associated with the maximum funded IUL. First, I'm going to talk about the IUL expense ratio, then I'm going to talk about the IUL expenses versus alternative, and lastly, I'm going to talk about the net rate of return of an index universal life policy. First, let's talk about the IUL expense ratio. Now, what I'm going to use for today's analysis is a 45-year-old male in good health, $1 million death benefit. We're going to fund the maximum premiums into the policy that the IRS allows, and we're going to fund it for a 10-year time period. Now keep in mind, the IUL expenses will differ for each client primarily based upon three things. First and foremost, the most important is the design of the policy. See, a maximum funded design is going to have lower expenses than a minimum funded design, and there's a reason for that. A life insurance policy is primarily made up of the death benefit and what's called PUA. It means paid up addition. And when we design a policy for maximum funding, more of that money is going towards the paid up additions or cash accumulation, and less is going towards the cost of insurance. Second is the insurance company selection. Some insurance companies just have higher expenses than others. And lastly, the age, gender, and risk of the insured. Now, generally speaking, the older you are, the less healthy you are, and the higher cost of insurance is going to be. Now, what you're looking at here are the annual IUL expenses as a percentage of the account value. And you can see that the expense ratio is higher in the early years and lower as the years go on. Now, if you look at the IUL expense ratio to age 100, the average expense is 1.03%. which is in line with other financial vehicles. And in fact, if you have an IRA or a 401k, there's a good chance you'll be paying 1.5% to 2% a year in fees between the advisor fees and the fund fees. Now, to dive down a little further, what if we excluded the 10-year funding period? Again, with this policy, we're going to be funding the policy for 10 years and without any additional premiums after year 10. And looking at the policy expense ratios in years 11 and ongoing, the average expense is only 0.2% or 20 basis points. That's very inexpensive. Now, if we do the exact opposite and we exclude the 11 years plus, and we only look at the first 10 years, the average expense was 4.76%. And that is because IULs are front-loaded, just like many mutual funds. We could definitely conclude that that is expensive. And we conclude that over time, a 1.03% expense ratio is in line with other vehicles, and possibly even less. Now let's compare IUL expenses to the alternatives, such as an IRA or 401k. Now I looked at funding the same amount of money into an alternative vehicle, which is a non-qualified equity account, the exact same illustrated rate of return of 6.9%. Now, I'm assuming the top marginal brackets. We do that because most of our clients that gravitate towards this are high income earners. Not only that, we're currently in one of the lowest tax brackets in history, and we expect taxes to go up. IULs are a great place to put money if you're looking for a legal way to avoid taxes. Now, if we compare the exact same money going in, the same exact gross rate of return of 6.9%, and look at the expenses through age 100, you can see that the IUL expenses were at $542,000 versus $3.1 million for the alternative, which is a non-qualified equity account. Now, we can break it down between the expenses, the management expenses at 1.03% of the equity account, the taxes, which are going to be based on dividends and the portfolio turnover. We could look at the expenses of the IUL as well as the cost of insurance. But to show you this more visually, I looked at the total expense of both at age 85. Now, the total expenses at age 85 for the IUL is $235,000. Now, if we break that down, roughly half of those were administration or expenses, and the other half were COIs, or the cost of insurance, which is used to pay for a life insurance death benefit for you and your family. Now, when we look at the non-qualified equity account, exact same money going in, exact same 6.9% gross rate of return, management expenses were $603,000. And the taxes were $873,000. Now again, those are the taxes on dividends and portfolio turnover. The frictional taxation along the way were a total sum of almost $1.5 million versus $235,000 for the Index Universal Life Policy. Now, we looked at the IUL expenses as an expense ratio and compared the IUL expenses to the alternative. Now, let's lastly look at the net rate of return of the IUL. In the earlier years, the IRR, the internal rate of return of the policy, will be lower due to the front-loaded expenses and due to surrender charges, which gradually decrease over time if you were to walk away from the life insurance policy. Again, if we look at it in a more visual, appealing way, we look at the IRR and the fee dragging at age 85. You can see again the exact same 6.9% gross rate of return. The net IRR after the policy expenses was 6.22% for the IUL with a fee drag of 69 basis points. When we compare that to the non-qualified equity account, again, the exact same 6.9% gross rate of return, that IRR was 4.23% with a much larger fee drag of 2.68%. Those are all the management expenses and taxes on the dividends, portfolio turnover, and the frictional taxation. So ultimately, what does this mean for your money? Now, if you were to fund the exact same money or dollars into these two different financial vehicles, a maximum funded IUL or non-qualified equity account, we're funding a total amount of $686,000 over a 10-year time frame. The equity account grew to $5.7 million through age 100, despite all the fees and all the taxes. However, with the same dollars going in, the same 6.9% gross rate of return, the IUL over that same time frame grew to $15.7 million. That's a $10 million alpha or difference between funding into an equity account or funding into the Index Universal Life Policy. And that's primarily due to the lower fee structure of the life insurance policy when we maximum fund. Now, you may be asking yourself, are you looking to pay for less in taxes? Are you looking to create more tax-free income for your retirement? Or are you looking to create more wealth for your family? Well, you may want to consider a properly funded Index Universal Life Policy as part of your complete holistic financial plan. If you have any questions about the material discussed or how an IUL may look for you, please contact me today. Thank you very much, and we'll see you next time.